Good day, ladies and gentlemen. My name is Mulko Mapai. You are e-tutor for FAC 3704. Today I'll be chatting to you about the Goodwill and Gain on bargain purchase. We'll kick off our discussion with non-cash consideration, move to the measurement of NCI, move to Goodwill and Gain on bargain purchase, then we'll close it off with the allocation of Goodwill. This does not necessarily mean these are more important topics than others. You're still expected to go through all your material to cover all the topics. Let's kick off with non-cash consideration on the business acquisition. An entity shall account for each business combination by applying the acquisition method in line with IFRS 3. So an entity can acquire equity in the other entity by either paying cash, giving them asset, take some liabilities, issue equities, or the combination of any of the above, be it giving them asset and cash, equity and asset, and so forth. And then the acquisition through any means other than cash is regarded as non-cash, as there is no cash exchanging hands. So it's more of like a barter trading. So IFRS 3 says when that non-cash transaction has been made, it shall be accounted at fair value on the acquisition date. Now let's look at the example for non-cash consideration. On the 31st March 2022, Company P obtained 100% control of Company A. As part of the acquisition, the parties agreed the purchase price to be as follows. P gives a previous shareholders of A the office building, which was acquired 3 years ago at 1 million, and the accumulated depreciation was 300,000. Therefore, the carrying value would be 700,000. Then, on 31st March 2022, the fair value of the building is determined to be 750,000. P have also issued 10,000 shares to the previous shareholders of A, and then the share price at 31st March was 2 rand. Then we're required to determine the value of consideration for the control obtained. So from this example, we know that the control was obtained on 31st of March, and then it was through a non-cash consideration, which was they give the previous shareholders an office building, and they've also give them some shares. So we need to say, okay, what was the fair value at acquisition date? The building we've told that was 750, and then we know that they gave 10,000 shares, and then the share price at acquisition date was 2 rand. So 10 by 2 will be 20. So 750 plus 20 will land a total consideration of 770,000. Now let's move on the measurement of the non-controlling interest. So the NCI can be measured in two ways, either the fair value or the proportionate share of net asset. So the names are more or less self-explanatory. If it's fair value, it means you need to know what's the fair value of the NCI at acquisition date. So let's look at the example of the fair value. They say A Limited acquired control with the acquisition of 80% interest in B Limited for 1.1 million on 1st January 2015. On this date, the share capital of B was 200,000, which consisted of 200,000 shares. Then the fair value of the net asset of B Limited was 1 million on 1st January 2015. The market value of shares of B Limited on 1st January 2015 was 7 rand per share. So we know that A owned 80% of the 200,000 shares. Therefore, the NCI will own 20% of that. And then we've also told that the fair value is 7 rand per share. Therefore, the NCI will be 7 rand per share by the total number of shares by the percentage that NCI own, therefore will land with 280,000. So those that prefer the analysis of owner's equity, you can look at page 27, example 1.6 is laid down nicely there. Moving to the next bit, which is proportionate share. So this one you need to say, okay, using the same example, how much is the net asset? Is 1 million. How much is controlled by the NCI? Is 20%. Therefore, net asset by 20% will land on 200,000. Let's move to the Goodwill Gain. The Goodwill Gain is determined by the sum of the fair value of contingent transferred, the value of NCI, and if the business was acquired in phases, the fair value of the previous amount paid, and then we less the fair value of net identifiable asset at acquisition date. So if the difference is positive, then you will land with a goodwill, which means there are other assets that you've acquired that we are not necessarily seeing on the balance sheet, things like customer loyalty. And then if it's negative, you will recognize the gain on purchase. Let's look at the example. So A Limited acquired control with the acquisition of 80% interest in B for 1.9 million on the 1st January 2015. On this date, the share capital of B was 200,000, which consists of 200,000 shares. Then A Limited elected to measure the NCI at the proportionate share of net identifiable asset. So scenario 1, they said the fair value of the net asset of B amounted to 1 million rand on the acquisition date. So looking at the percent transferred would be 1.1, then NCI will be 1 million by 20%, then land at 200, and therefore A will be 1.3. And then we're told the net asset is 1 million. So the difference between those two will be positive 300. And then because it's positive, that will be a goodwill. Jumping to scenario 2, contingent transfer is still the same. The NCI is 20% of the net asset, which is 1.5. Then we land a total of A to be 1.4, and then the net asset of 1.5 million. Therefore, the difference there becomes a negative 100. And because it's negative, we'll have a gain on bargain purchase. Closing it off with allocation of goodwill. Let's look at the example. A Limited acquired control with the acquisition of 80% interest at B for 1.1 million on 1 January 2015. On this date, the share capital of B was 200,000 rand, which consisted of 200,000 ordinary shares, and the retained earnings was 800,000 rand. The market value of shares of B on 1 January 2015 was 7 rand per share. So let's assume the first scenario where we say NCI is measured at fair value. So consideration transferred is 1.1. The amount of NCI is 280. Therefore, the total is 1,380,000. Then we are told the net asset is 1 million. And then the difference between A and B is 380,000. And because it's a positive, we'll have a goodwill, total goodwill of the group. And then because this is measured at fair value, there should be allocation of fair value between the NCI and the parent. And for you to do that, you say the goodwill for A paid 1.1 million. And then what is the portion of the asset that is owned by A? It will be 80% of the net asset, which is 800. Therefore, for the difference between what they've paid and what they get in terms of the net asset is 300. And then for the NCI, we need to say what's the fair value of NCI is 380, And then what is the portion of net asset that they own? Is 20% of 1 million, and therefore that's 200. Then the 200 less 280, you are lending at 80,000. And therefore, if you take the portion of NCI goodwill and the A limited goodwill, you're getting back to 380. That's 300 plus 80,000. And then the total goodwill of 380 will have to be presented in the consolidated statement of financial position of A limited group. Now let's move to where NCI is measured at proportionate share of net identifiable asset. Consideration transfer is still the same, 1.1 million. And then the amount of NCI will be the net asset of retained earnings and share capital. By 20%, we land at 200. And therefore, the total A will be 1.3. And then net identifiable asset is 1 million. And the difference between A and B, you are lending at 200. And then because it's positive, it will be a goodwill again. And then because this is measured at proportionate share, there won't be allocation between NCI and the parent. So that's the main difference. And then if you prefer the analysis of owner's equity, you can look at example 1.6 in the tutorial letter, where it's laid down nicely for you to look at. I think that's the end of my presentation. Thank you for listening and watching, and I wish you the very best for the rest of your academic year.